Great. Okay, so Resi, what are we? We're an investment trust that invests in social housing. I'll come on to explain what I mean by that in a moment. We target a secure, long-dated dividend yield of 5% per annum, with intention to grow that in excess of inflation, which gives us a total return in excess of 8% per annum. There is some potential for upside on top of that as well, which I'll come on to explain a little bit later. Now, what are the key differentiators of Resi versus other people in the market? First of all, we have a requirement that all of our investments must be able to support long-term investment-grade debt at our target leverage levels. This is a key limitation for us. We have, in building our portfolio of around 300 million, looked at about 3 billion of opportunities. A lot of those that we have turned down have been because of this limitation. So it is very important. Next is we have a subsidiary, Resi Housing Limited, which is a for-profit registered provider of social housing. That means it is regulated by the Housing Regulator to provide social housing, which allows us to do two things. One is access government grant money to allow us to turn normal accommodation into social housing. And second is to buy units that planning requires to be social housing as well. So you may have heard of Section 106 units that are the 20 to 50% of units that are required to be affordable in a new development. So you have to be a registered provider to be able to acquire those units, which we are. The next differentiator is we're managed by the Trade Risk Group. So Trade Risk itself has a long history in social housing. We've been active in the sector for the past 18 years, working as advisors to housing associations and local authorities, helping them with their funding needs. So we've combined the financial expertise of trade risks with a lot of housing expertise in our management team. So in particular from my colleagues Pete Redman and Mark Rogers, who have previously managed large housing associations, Clarion and Notting Hill Housing, which between them own about 130,000 homes across the country, and they have 80 years of experience between the two of those. So we have a great experience in this sector, which we believe is very important. Next is, I mentioned before that we invest in social housing. What do I mean by social housing? So we define that as three things. First and most importantly is below market rents. This is fundamentally the most important thing in this sector because accommodation should be affordable to people. Affordable means you're offering something that the market does not by itself. Next is our diverse income stream from economically insensitive tenants. I'll explain that for each of our different investment classes. And third is we focus on strong counterparty covenants and managers. So we have tenants who are shared equity tenants, by which they own a stake in the home that they're renting from us. We let directly to local authorities who are generally AA rated entities. And then when we work with housing associations, we work with large creditworthy housing associations. So our two partners are Places for People Group, who own or manage 198,000 homes, and Metropolitan Thames Valley Housing, who own 57,000 homes in the southeast. So these are very large, established organisations. They've been around for at least 40 years. They know what they're doing very, very well. Okay, so those requirements have led us to put together a portfolio of about 323 million across 2,400 properties, invested in three sectors, which I'll explain each of them individually to you. So the first is shared ownership, where roughly 77 million of our portfolio is. This is also the predominant focus of our deployment going forward. Next is local authority housing, which is the smallest with 36 million. And finally, retirement rental, which is the largest of 210 million. So I'll now explain what each of those three portfolios are individually. So first is shared ownership. So shared ownership is an affordable home ownership product. The idea is individuals or couples buy a stake in the home and rent the remaining 75% from ourselves. That bit that they rent at a below market rent, which is the affordable product that I mentioned earlier, the key being the below market rent. But for our perspective, it's a very good very strong rental stream for two reasons. So one, it's below market. Second, it functions like a ground rent. So if they don't pay the rent, they default on their ownership stake in the home, which gives us a lot of security. And then finally, that rental stream is growing contractually at RPI plus 0.5% a year. So there is a lot of certainty in that cash flow as well as security. Now, I mentioned our portfolio is 77 million. It is in two locations at the moment, so Clapham Park and Totteridge, both in London. Those areas both have huge housing affordability issues. So house prices to average earnings in those locations are between 14 to 16 times. So you can see there's a huge gap between where people are able to get a mortgage for outright purchase and the actual house prices in those areas. So shared ownership becomes the only option for most of the population to be able to get on the housing ladder. If we look at some numbers there, I'm afraid I don't have these on the screen, but if you were looking at an average London flat of £500,000, in order to buy that on an outright purchase basis, you would need to put down a £50,000 deposit, and you'd be paying £30,000 per year on your mortgage. In comparison, you could buy that same flat on a shared ownership basis, so £500,000. You'd only have to put down a deposit of £12,500 to buy your 25% stake. And then, importantly, your ongoing payments would be £20,000 per year, so 2/3 of what they are under the open market option. So you can see it's very affordable from two perspectives. One, getting a much lower deposit to enable people to get on the housing ladder quicker. And two, and equally as important, those lower ongoing payments. So in terms of some numbers around shared ownership and what the returns are from those, it is a relatively low yielding asset reflecting the underlying security that you have, as I mentioned earlier. So the net rental yield on shared ownership is 3.4%. Now the question becomes, how do you get an asset that yields 3.4% and pay a 5% dividend out with that? So this comes down to the long-term investment grade debt that I mentioned earlier. So we put in place on our shared ownership portfolio long-term, by which I mean 40 plus year maturity, RPI linked debt. Now, if you invest in government gilts, you'll know that RPI linked gilts trade at around kind of -2% now, which means we're able to raise debt at around the real cost of about 0%. So if half your capital is coming from debt where you're paying 0%, that means that you can pay out a 6.5% return to the other half, which is your equity piece. Now that debt, as I mentioned, is RPI linked, which matches the underlying income stream being RPI linked as well. So that enables us to get that 6.5% leverage yield, which gives us our 5% dividend yield after costs. I mentioned there's an additional upside available on shared ownership. So this is what we call staircasing. So the idea of shared ownership is that people over time will buy bigger stakes in their home. This is an upside for us because when they do so at the then open market value, whereas we've bought these properties at a discount reflecting the lower rents that are charged in the interim. So we like this asset class a lot because of that secure, long-dated RPI-linked income stream with upside to come from the staircasing, as I mentioned earlier, and hence it is our predominant focus going forward. It does require that regulated vehicle that I mentioned earlier, Resi Housing, to invest in this. So there are competitive advantages that we have here. Okay, our next area is retirement housing. So this portfolio is age restricted, but it's very much not to care. It is a very simple portfolio. Basically, these are flats within retirement blocks. So individuals will have a kitchen, lounge, bedroom, and bathroom, but there will be shared common facilities that they can also access. So a shared lounge, shared wash facilities, and also shared gardens. So people typically move into these flats because their partner has passed away. They want something that's more manageable. And also, most importantly, there is social interaction to address loneliness, which is an increasing increasing problem for the elderly population. So this portfolio itself, we are leasing to individual retirees. What that means is that from an income perspective, our income is coming as rent is coming from their pensions, which may be topped up with pension credit or housing benefits in order to help them pay their rent. Importantly, the portfolio is rented out at what's called local housing allowance level, which is the level that you can receive pensions credit or housing benefits to should you require. So that means the portfolio is economically delinked. We don't require people to be in work in order to continue to live in these assets. Portfolio itself dominated in southern England in kind of retirement hotspots. There's also about a quarter of the portfolio that is used to house the property managers of retirement blocks. So I mentioned ours are individual flats in those blocks. Those blocks will typically have 50 flats. We will rent 5 of them privately, and the other 45 will be owner-occupied. There's also a house manager living in those blocks, and we rent the flats to them. That rental stream is even more secure for us because that comes from the service charge of all of those 50 leaseholders within the block. So it becomes a ground rent like RPI annually uplifting rental stream. As I mentioned earlier, this portfolio is managed for us by Places for People Group, and we've also done some value additive management exercises, which I'll explain when I talk about numbers a little bit later. There are some numbers in terms of the economics of the portfolio in the top right. I won't go through them now, but we can come back onto those later. The third area that we invest in is our local authority housing portfolio. So what this is doing is leasing accommodation to local authorities to enable them to provide housing for people who are either homeless or at risk of homelessness in their borough. So local authorities do have a statutory obligation to house anyone threatened with homelessness in their borough. Now, you think of homelessness, you traditionally think of people living on the streets. That's not the case. There's now 320,000 homeless people within England. A lot of those are working, and they've been made homeless because they may have split up with their partner, or more commonly, their landlord has decided to either increase their rent to a level that they can't afford, or has decided to sell their flat. So local authorities have a huge problem housing these people. Their go-to solution is hotels, bed and breakfast, where they'll pay a huge amount of money. So what we do is rent accommodation to them at market rents. The local authority guarantees the voids and does the maintenance for us. So for them it is great because they're doing a real saving in terms of compared to that hotel's bed and breakfast. From ourselves, we're getting a very secure income stream leased to the local authority for 7 to 9 years that is generally growing with inflation. Why do we only have 7 to 9 year leases? That's relatively short. There is an explanation here. So the local authorities themselves can't do more than 10 years without receiving a lower amount of money from central government for housing these homeless people. So we work with local authorities who have huge needs and want to work with us in the long term, which is our portfolio in Luton specifically, but they can't because of the financials. For us investing in this area, it is very important to invest in the right locations where there is huge demand for this type of accommodation for the long term. So hence kind of metropolitan southeast, some of the devolved authorities, Manchester, Bristol, etc. We've looked at a large amount of opportunities in this space that wouldn't work for us. The local authority may be able to give us a 10-year lease, but we can't get happy with the kind of 30-year view on that area. So for example, in Barnsley, we looked at a portfolio recently. Next slide. Origination of registered provider. So I mentioned earlier that we have a registered provider within the group, so a registered provider of social housing. It is regulated by the housing regulator that regulates all local authorities that provide housing and also all housing associations. So it regulates people who own about 4 million homes. That regulator has a duty to protect tenants' interests, but we believe that is very much in line with what we would looking to be doing as a responsible landlord anyway, investing for the long term. So we don't see any conflicts between our requirements under that regulation and our intentions to shareholders. As I mentioned, the registered provider does give us advantages, so it allows us to access that government grant money that we're using to subsidise shared ownership. We've drawn down 6 million already. And it also allows us to buy those Section 106 units that planning requires to be affordable. In terms of our board of that entity, we do have independent directors who are there to represent tenants' interests and protect the regulatory part. They're very well regarded. So one, Jill Rowley, was formerly head of regulation at the regulator. And the second, David Orr, has just stepped down as Chief Executive of the National Housing Federation, which is the trade body for housing associations. So these two people did a lot of due diligence before they joined us. So I think you should get a lot of reassurance about that. In terms of our pipeline going forward, I mentioned earlier that it is very much focused on shared ownership because we see that as the most attractive of the asset classes we look at and the most attractive opportunity to invest in social housing. We've built a portfolio, we've built a pipeline, of about 500 million at the moment of opportunities we could do this year if we had available capital. And that reflects contractual arrangements like we have with Morgan Sindall and also strategic partners who we've worked with in the past. So the likes of Metropolitan Thames Valley Housing, who I mentioned before, who we bought our Clapham Park scheme off of, and Crest Nicholson, who we bought our Totteridge scheme off of. And we're working with a number of other house builders who see shared ownership as a great way to increase the amount of homes they're delivering because it doesn't compete with open market sale, so it allows them to deliver additionality in terms of their developments. So we're not just delivering additional affordable homes on the shared ownership, we're also delivering additional homes that wouldn't otherwise be able to be built. Financial highlights, as I mentioned earlier. So Resi IPO'd in July 17. Since then, we have delivered a 14% total return. So our net asset value is now 108p. So that's grown up. That's grown by 10% from 98p at issue. And we've also paid out around 5.5p as dividends. So that was 3p in year one, 5p in year two, which we're currently halfway through, with the intention to grow that, as I mentioned, in excess of RPI going forwards. That NAV growth, as I mentioned, we've done some value add in the portfolio. So in our retirement portfolio, we own those properties leasehold. We've extended those leases from about 70 years to 150 years, and we did it in a way that was additive to our cash flows, which I'm happy to explain a little bit later, but it's quite complex. So that's the NAV piece. We are also, as the fund manager, very aligned with shareholders. We own 2.5 million shares, both directly and indirectly through our directors. Next is we've also done a share buyback program to support the share price. So we were slightly late to deploy compared to our targets at IPO, which did lead to our share price declining last year. We realised that there was value to be had in that for shareholders if we bought back those shares below NAV, and that would also support the share price. So we bought back 9.3 million shares last year at an average price of 92.5p, which has added about 0.5 per share for other shareholders. Next slide I want to talk a little bit about is social impact. So this is very important for us. We are investing in social housing. Now there's two ways of looking at social impact. The first and simplest is those below market rents that I mentioned. That's very easy to measure. So in our shared ownership portfolio, for each of those £500,000 flats that we deliver as shared ownership, that delivers a reduced rent with a present value of £86,000 to the shared owner. So that's 14 million of value across our shared ownership portfolio in terms of reduced rents. Next is we're also delivering benefit in terms of, for shared owners, people are knowing that they have their own home for life. They don't have to worry about potentially being kicked out in a year or two because their landlord decides to yank up the rent or their landlord decides to sell, as I mentioned earlier. In the local authority housing, we're providing homes for people who would otherwise be either homeless or would be living in hotel bed and breakfast accommodation, which is pretty horrible, particularly for young families. And then in the retirement portfolio, as I mentioned, it's particularly about supporting independence for longer, providing that social interaction that people might not necessarily have access to, and also freeing up large family homes further down the housing ladder as well. So we give people a rental option to allow them to have different opportunities for what they can look at on a retirement basis. Next, I've got a quick slide that just gives an overview of the fund manager trade risks. As I mentioned, we are long-term advisors to the sector. You can see some pieces in here. Just to draw out a couple of facts. So first of all, the graph in the bottom left shows which of those large housing associations trade risks has worked with over the past 5 years. So all those highlighted in yellow we've operated with. So that's about 75% of the top 20 housing associations. And then a lot of what we do is debt. So here, Trade Risk competes with the larger UK investment banks, and we do very well. We're number 6 in the league tables for bond issues and placements for housing associations. So the only ones bigger than us are the big UK high street banks. This slide is the key terms. I'm not going to go through this now. This is more for your pack. And then finally, just to kind of summarize everything we've kind of talked about before we come on to questions. So we're about delivering a secure, long-dated, inflation-linked dividend yield of 5p, growing that in excess of RPI, giving us our 8% per annum target, with the potential to outperform that from staircasing, as I mentioned earlier. In the 21 months since submission, we have delivered total shareholder return of 14p, so in excess of our target. Next is we do have a really secure income stream benefiting from, as I mentioned, below market rents, that diverse income stream from economically insensitive tenants, either because they're retired and paying their rent out of pensions, or they're shared owners, so they have an ownership stake that they would lose if they defaulted, or we're letting direct to local authorities who not only have a statutory duty to house people, but are also very strong entities in their own right. And finally, we're working with very strong covenants and managers. So conversely to that, what are we not doing? We're not doing anything in the care sector. Why are we not working in the care sector? It doesn't really satisfy our tests. So first of all, you have above market rents. Second, it's very complicated to manage. And third, it wouldn't support long-term investment grade debt at our target leverage levels. So by long-term, remember, I'm talking kind of 25 to 60 years. So in our retirement portfolio, we use 25-year fixed rate debt. On our shared ownership portfolio, 40-year RPI-linked debt. And then finally, that social impact factor, which is very important. So we focus on delivering additionality to social and affordable housing, as well as overall housing. So with that, I'll kind of move on to any questions. Here's the microphone. Oh, sorry.
I note that your net debt seems to have risen by about 160 million, broadly equal to your current market capitalisation over the last year. Is that something we should be concerned about?
Yeah, so just to bring up this this slide, so we've got the numbers in front of us up in the top right there. So our debt is currently 105 million. That is 36% of our loan to value. It's below our target of 50. That will go up to 50 as we put in leverage on our remaining portfolio as we finish off our deployment of our IPO capital. Is it anything to be worried about? No, and there's two reasons. So first of all, that's supporting returns. And secondly, that is long-term debt that we're deliberately not exposing ourselves to the traditional risks of leverage. So the risks of leverage are, one, in the short term, you may have to pay it back, and you're either exposed to having to sell assets to do so, or to increased interest rates when you do so. So we've removed that risk. And the second is exposure to covenant risk. So generally our leverage avoids loan-to-value covenants, so it's about cash flow stability. As I mentioned, we're only investing in assets that have those very strong cash flows, so we have huge amounts of headroom in those covenants. So the question was, what is our exposure to long-term maintenance? Are we putting those obligations onto tenants? And if we are, what recourse do we have to make sure that they are following or that they're keeping the property at the required standard? So in terms of, are we putting that onto tenants first of all? For shared ownership, that is an obligation of the shared owners. In the retirement portfolio, we manage that ourselves, but we have a very strong kind of 30, 40-year business plan that looks at those costs. And then in the local authority space, that is the responsibility of the local authority typically. How do we monitor that and maintain that? So just going through each of those again. So shared ownership, these are typically flats. So the only responsibility the tenant has in terms of maintenance is to within their flat. So it's kitchen, bathroom primarily, carpets, decoration, which is relatively simple. If that goes wrong, we do have recourse to their stake if it does. The actual building fabric is controlled through the service charge and by the freeholder themselves. In terms of the local authorities, we have dilapidation clauses in the leases. So if they don't maintain the accommodation to the standard, we can collect that money off them at the end of the lease. Actually provides an incentive for the local authority to renew the lease. But importantly, we are monitoring this constantly. So our property team are visiting these properties probably every 2 weeks in terms of the local authority housing, to ensure that we're working well with the local authority to provide great accommodation for our tenants. And did you say you had a second question as well?
Yeah, it was kind of curiosity. You mentioned below market rents. What is a below market rent? I mean, is it a percentage below what you commercially let the property out at? And is it adjusted for the shared ownership? Presumably they own 25%, so it's 25% below market rate anyway.
Yes, so on the shared ownership, what does that mean? So we charge a rent only on the 75%, and we charge a rent that's set on day one at a maximum of 2.75% of the open market value. So that's a government requirement, which is pretty much below the London average of around 4%. So that is a requirement. Now, over time, our rent grows with RPI, so there is a potential for that to move out in terms of market, but that is a contractual position. So that's what that means. So it is broadly 30% discount in London.
You mentioned staircasing in shared ownership. What kind of proportion is currently owned outright by the tenants, and what proportion is owned by you? How do you see this going forward? Is there are a lot of people opting to staircase up, and how would this actually affect your business model? Do you see this as something favourable if more people opt to buy larger portions of their flats? I mean, as I say it, it's a balancing act between a capital gain and long-term rental income. So how do you see this affecting your business model?
Yeah, so there's a couple of questions within there. So first of all, is in terms of what are typical staircasing rates. So there are now 200,000 shared ownership properties within England. Shared ownership's been going for about 40 years. Typically, those rates vary between 1% to 8% per annum. So we assume a long-term rate in our models of 2% per annum. Why does it vary? Well, conversely to what you'd expect, staircasing rates end up being high when house prices are high, low when house prices are low, reflecting the fact that when they're higher, people are more confident, and so they may be able to buy bigger stakes in the property, or more likely, they're more likely to move home at that point, and so staircase direct from their 25% stake on day one up to 100% at that time. In terms of the ownership stakes that people typically have, in London, that is typically 25% on day one. Across the rest of the country, it is probably a 35% average. So outside London, it is closer towards 50%. Just reflects house price earnings as a multiple. Sorry, house prices as a multiple of earnings in those areas. In terms of what do we prefer, staircasing or not staircasing, I think it would be great if we could just sit on the asset forever and collect the RPI-linked rent. That isn't going to happen because ultimately people will buy bigger stakes over time. That does obviously give us a profit, but we have to reinvest that profit in that time or ultimately repay the cash to shareholders if we can't. So it's good to have a nice balance between the two. As I mentioned, in terms of our returns, they're all targeted just based on the rent. So for us paying our 5p dividend, we don't need any staircasing to happen.